options are part of an asset class called derivatives. Right? Got the big bubble and like the little bubble type stuff. Anyways, derivatives, if any of you have taken any sort of calc, they derive from stocks, stock price. Right? So we got a stock price that determines the price of the derivatives, and then options are a part of these derivatives. So to understand how derivatives in general are priced, we have to understand how stocks themselves are priced. So let's say you are the CEO of ABC Corporation, right? You can just imagine ABC Corporation doing whatever. You have 100% of this company currently. Like you own 100% of this company. Yo, we're just going over stock price. But let's say you wanted to sell some of your company, a certain percentage. Let's call it, just for round numbers, let's call it 50%. 50% to give, I don't know why I'm writing numbers. 50% to keep. And let's say you assign 1% per share, meaning 50 shares, right? So you have this company, you're the owner. At first you have 100%, but if you wanted to sell any portion of that company, of ABC Corporation, you can assign some sort of percentage that you want to sell, and then you can assign a percent value for that amount of shares. So here it's 1% of ABC Corp, and then there's 50 shares available. Should I erase this? Okay. So I'm gonna talk about IPOs actually. So you go and then you make an initial public offering. Initial public offering, right? You, let's say, you assign $10 per share for like, and that share is 1% of ABC Corp. So theoretically, if you sell all these 50 shares, like if all of these 50 shares get bought from you, then you've made 500 bucks. Obviously, it's way bigger than this, talking like millions. But for simplicity, we're gonna keep it like this. So you go and you offer to the exchange, you're like, okay, ABC Corp, I'm offering 50 shares at 1% equity for 10 bucks. So IPOs are sort of what investors use to try to get a head start before the company even goes public. This is, again, initial public offering. It's not the actual public offering. And so investors, they can look at this 10 bucks and then say, okay, I'm gonna bid higher than this. I am happy with this company at 12 bucks or 13 bucks or 15 or 20. And then there's other people, that's the people who still like this company but want it at a like lower price than the initial. And then they go, okay, maybe 8 bucks or 5 or whatever. Let's just say for simplicity's sake, the average ends up to 10 bucks also. So now, ABC Corp is public. ABC Corp for $10 based on that initial public offering. So how does the stock move after it's public? This is what we call like order flow. Let's say, theoretically, this is number of people willing to buy, and then this is price. Let's call this $10. This is what it's at right now, right? What do you guys think? How much do you guys think is going to be over here and over here and over here? Guesses are completely fine.
Well, the most are going to be in the middle, right? Between the number of people willing to buy and $10.
Well, if you want to buy a stock, do you want to buy it at the current price or do you want to buy it cheaper or more expensive?
Again, the left.
Cheaper.
You'd want to buy it cheaper, right? So the buyers are going to cluster up over here, and then there's going to be like a sudden dip. Nobody really wants to buy the stock at exactly what it is. They're going to want to buy it a little bit cheaper, a little bit more expensive, or not a little bit more expensive. They're going to buy it like at a discount.
Is that so they can resell it immediately?
Well,
Well, if the
not
price is
necessarily.
$10 and you buy it from for $9 for whatever reason, then you can just sell it right away and make money.
It's just like the value of the stock.
Well-
if it's valued at $10 and you don't believe that it should be valued at 10.
Yeah,
Like, why would
we're
you
gonna
do
get to
that?
the selling soon. That's assuming that there are sellers here. When in actuality, it's the opposite for sellers. Sellers are going to cluster up over here. This isn't a healthy market, by the way. Healthy market. Sellers want to sell their stock for higher than it is right now. And so they're going to put orders for a higher amount than what it is right now so that they can actually profit from this difference, whatever it may be. This is assuming it's a healthy market. What actually makes stocks move though is how many buyers are here and how many sellers are here. So if there are more, I'm not using words. If there are a greater number of buyers than sellers, then the stock price is going to move this way. Because the stock price is actually the average of these two based on how much there are and what the price is at. And so the price is going to move this way if there are more buyers than sellers, according to this graph. If sellers are greater than the buyers, then the stock price is going to move this way. Because sellers are trying to get more and buyers aren't really buying at these prices. So this is the fundamentals of how the stock moves. It's all about supply and demand. How much there is, how much supply there is, how much is being sold, and how much is being demanded, how much is wanting to be bought.
Why does the stock go down if there's more buyers?
Right. So this is basically this price right here is the average of these two based on how many buyers there are and the price that they want. So if there's more demand than supply,
Then price would go up, right?
it will go down.
No. When demand and supply means price is pushed upward.
Because just people want it more. There's less of it, so they pay more.
You're moving along.
They're demanding less. I'm saying if their limit orders, if they're less than the actual price right now, and there aren't enough sellers to actually get filled over here, then it's going to move this way because sellers are trying to get rid of their inventory.
Yeah,
So
but
if
they
there's
want
more
to sell
buyers
it at a
than
higher
sellers,
price.
hold on. If there's more buyers than sellers, the stock price should go up because people wanna buy it.
People,
I mean, not that many
that's,
people wanna
that's
sell it.
if people want to buy it at this price right
Hold
here.
on, but if there's if there's more buyers than sellers, that means at this price, more buyers want it than sellers wanna sell. So the sellers think the price is too low, right? Because
Okay.
otherwise they'd be wanting to sell it.
Okay. I didn't make it clear, right?
Cause you're going off the assumption that
That they
all
want
the
it for
orders are only at this level. If
Mhm.
all the orders are resting at a certain level, then yes, the price will most likely move towards that level.
I should,
Against
I
what?
should clarify, If the buyers are adamant on buying,
Or do they sell at another price? I mean, there's a stock price, would they say, oh, I wanna sell this but only at $2 less? Or is
Wait,
it just
hold
at
on.
the price?
if buyers are adamant on buying the stock and they actually believe in it, they're going
Okay.
to want to buy even at a higher price.
Okay.
If there are more buyers than sellers, there's not enough sellers to accommodate for, that amount of
people also-
buyers. And so then the buyers would go up. If we're assuming that the buyers
Well, I
are
agree.
actually bidding for less, then the price is gonna go down. It's the same with the sellers.
Well, then you're saying if buyers exceed sellers, then. Okay. no.
Yeah, and then we're gonna say if sellers are adamant on selling, and there are more sellers than buyers, then the stock price is going to go this way.
There's a difference.
It just
between-
depends on the limit orders being placed there. We'll talk about limit orders.
It's
soon.
So if B is less than S, then the price goes up, and if B is greater than S, then the price goes down.
DNS.
Generally.
B and
Like
S,
buyers
buyers
and
and
sellers.
sellers.
Oh, yeah.
Yeah, generally.
We should write that, this is like street econ 101.
I mean, I think these
Yeah.
guys get it.
What's that, flying the bank or?
Should we talk about options? I don't know. So yeah, this is how options move, or stock price moves. Now that we understand how stock price moves, options follow a very similar pattern. Of course, they follow this exact same thing. If there are more buyers willing to buy options, they're going to push this way. If there are more sellers wanting to sell options, it's going to push this way. But there's also a mathematical layer behind it. Options are derivatives.
Like, does everybody pretty much get what we kind of just went over, like for the most part? Yeah.
Options are derivatives of price, the stock price. They allow you to say, at a certain time, so it's based on time, at a certain stock price, so it's based on stock price, and at a certain, I guess you can call it goal that the stock price reaches, we'll call that K. I want to be able to buy or sell 100 shares of company. Everyone okay with this? Based on time, stock price, and goal price, I guess you could call it. The video that I sent last meeting, I think, I don't know if it was a week after, if it was last meeting, but it went over what we're gonna go through right now. So let's say you're this person, right? This guy is known to be like the first person that ever traded an option. His name is Thales. He saw that olive pressers in the winter were less expensive to rent out than in the summer. Because in the winter, there's less olives. So you don't really need an olive press. So the merchants, I guess you can call them, they don't see any sort of demand. Yeah, there you go. They don't see any buyers, and so the price goes down. Let's say renting it out in the winter is $2 an hour. In the summer, it's $20 an hour. Winter's 2, summer's 20. So there's a huge difference here. If you wanted this price in the summer, you can't really do that unless you trade a derivative. So this guy Fallies, he goes to merchant right here, and he's like, I'll give you, say $5 if you agree to sell me your olive presser for the rate it is today, which is $2 an hour. So I'll give you $5 if you let me set this today's rent level, I guess you could call it, rent rate, at $2 an hour. If you make that set for me, then I'll give you $5. And I want this for the duration of summer. Let's call this 6 months. So I want to be able to use this for 6 months. So the merchant agrees to this because there's nobody buying his olive presser or renting his olive presser out, and he wants to make some money. So he says, okay, I'll take your $5. When summertime comes, I'll let you use my olive presser for $2 an hour. So what Thales did is he, in the summertime, said, okay, since this rate is $20 an hour, and I have it for $2 an hour, then I'm going to rent out the olive presser that I took from this guy for myself. So he becomes the merchant. He has his own presser. He makes $20 an hour, and he spends, I guess, $2 an hour that he gives to the merchant guy. And so he makes $18 an hour. And then he has this one-time payment of $5. We can account for that. At least for one time. So let's say he rented this out for like 10 hours. So he made 180. And then that day, he can give the money to a merchant guy. And then he made $175 in profit that day. And then after, he's going to be making 180 because he doesn't have to pay this anymore. This isn't a recurring payment, it's a one-time payment. Let's say in the winter, or in the summer, there's a huge drought and all the olives die. And there's no demand for any olive presses right now. And so the price is now at $1 an hour. Thales just lost a huge ton of money. He doesn't want to use this anymore. He doesn't want to use his right to take this olive presser for $2 an hour because there's no need. It's already $1 an hour. He's gonna be losing money anyways. And so he doesn't, we call it exercise. He doesn't exercise this right to have the olive presser for $2 an hour, and instead he loses the $5. Thales make sense? Any questions? Okay. If we want to apply this to the real market, let's say you're Thales in this example. You see Apple, for example. Do you know what it's trading at today? I'll just say 250. It's trading at 250. 250?
257.
And this is now. Let's say later, whatever that may be, let's call it 6 months again, so coherence. Apple is at 300. You like the price of today, right? Just like Thales liked the price of the winter time. And he wants to be able to sell it in the summertime. Let's say Thales was certain that Apple's gonna be at 300 bucks. Instead of just buying the share and only making 50 bucks, to buy the share, he'd have to put up 250 bucks for one share, and by this difference, he'd make $50. Let's say he wanted to buy 100 shares, he would put up 25,000. He would sell it. He would sell all of it for 30,000, and make $5,000. The initial payment is high though. Let's say you didn't want to do that. So you go to an owner of Apple, and you're like, I want to be able to buy your stock. Want to buy stock. More specifically, 100 shares. I want to buy 100 shares of your stock for $250, which is the current price. And I'll give you, let's call it $1,000. Right? So he wants to buy from this guy who owns 100 shares of Apple, his price, his stock at this price at a later time. And for that, the seller gets $1,000 immediately. Fast forward, now you, Thales, you see that the price is 300 today. And so what you do is you go back to this guy and you're like, okay, I want to buy your shares now, then I want to sell them again. This happens automatically. So you buy to 100 shares at 250, and then you sell it immediately at 300, which is the market price. You make the same profit with a much lower cost basis. You only put out $1,000 to gain $5,000 from this difference.
Why can't the guy just sell his own stocks, like, for 250 or for 300?
This guy?
Yeah.
If he was selling this, if he was selling Apple, then that means he didn't believe that it would go any higher than this. And so, like, yeah, you're right. Why would he, if he knew that it was going to go to 300, why would he sell it to someone else? Why would he sell his shares to someone else? And it all comes down to this guy was wrong. It's all speculation here. This guy, he was wrong about where the price will go in the future. And this guy was right. And so this guy profited and this guy lost.
I think what he's trying to say is that once it's already at 300, why doesn't he just sell it right away? But like, I think he doesn't understand that it's like contractually obligated.
Yeah, it's a contract. He's not allowed to share those stocks if he already agreed to the contract in the first place.
No, yeah, if it's at 250, you can't move it. But, no, I was referring that, like, yeah, if he knew that it was going at 300,
Oh, okay.
like, why couldn't he just sell it, at that price, but like you said, the answer is it's speculation.
He didn't know, exactly. And the unfortunate thing is, this guy, he just lost the opportunity to make $5,000, and this guy gained $5,000. So this guy lost what this guy gained. This guy lost an opportunity what this guy got in like actual profit.
And how does he gain $5,000 from the 300 or the 250?
So this guy,
Yeah.
he has a contract with this guy that he wants to buy Apple. He wants to buy 100 shares of Apple at 250, and now Apple's at 300. So what this guy can do is he can exercise the contract. He can go back to the guy, to the merchant, and then he can go, okay, I see the price now, and you're obligated to give me your 100 shares because I gave you $1,000 anyways, because we're in agreement. We traded a contract. And so you go and buy Apple for 250, and then you sell it immediately for 300, and then you make the difference.
After 6 months.
Yeah, at the designated time. We're assuming it's 6 months now because it's like easier to think about.
So like that guy is locking the price of 250.
This guy?
Yeah.
Yeah, he's locking in the price of 250, but at the time that it was 250.
But he's gonna buy it after 6 months. And immediately sell it.
Technically he's gonna buy it whenever he wants.
Like when the contract ends.
Whenever the contract ends, or during the contract, in the middle of the contract.
Yeah, when the agreement is.
This is the difference between what's called an American option and a European option, and we're gonna get into that a little bit later.
Mm-hmm.
Anyways, I hope that made a little bit sense. Any
No,
more
makes
questions?
sense.
Alright, bet. So this guy made 5,000 off of only putting up 1,000. He loses this money obviously because he gave it to this guy for a contract. His true profit is $4,000. The thing is, he didn't really put up much. He only put up 1,000 to be able to make 4,000. That is a 400% gain. And so this is how options are used today. It's for speculation and then for other things that we'll get into a little bit later on. But let's just assume for now that you were wrong. Now price is at 200.
So that guy still makes $1,000, right? No matter what.
This guy? Yeah.
Yeah.
He makes $1,000 from this agreement because he's also putting up risk. What if the stock price goes astronomically high? He lost the opportunity. We call it opportunity cost.
So from the owner's perspective, it's like a guarantee that he makes the money.
It's a guarantee, exactly.
Okay, so that's why he would do it in the first place.
You want to answer the question? Continue. If you don't, I think you're gonna answer on what you're
Oh,
saying.
okay. What if he was wrong, and instead Apple went to 200 instead of 300? So this guy, 2,000. The difference here is 5,000, but it's negative. He just lost $5,000. We were assuming that Thales, you guys, would want to exercise, would want to use up your contract with the owner of Apple, the 100 shares owner, because you see profit. You see that you have a contract with him at 250, and now it was at 300, but now it's at 200, and so you wouldn't want to actually use up this contract because you would lose $5,000 on the spot, including this 1,000. You just lost 6,000, and so you take the loss of $1,000. You just lose all of it. You lose 100% of your money, and that's sort of the caveat to options is that they're also extremely risky. If you're wrong about the price, it has astronomically bad, consequences. Yeah.
So it's impossible for the seller of the option to lose 25 grand in Apple stock, like for the value to go down.
We were assuming that this guy, he would want to exercise his option if the price was higher than it is with his contract. But it's not higher, it's lower. And so he wouldn't want to lose 6 grand, like on the spot. He wouldn't want to exercise this because exercising it means that he would lose 6 grand. Instead, this guy just takes the loss of $1,000. This guy gets to keep his shares, whatever they may be at. And so yeah, you're right. This guy, at that time, he just lost $5,000. But this isn't an exercise sort of loss because he didn't sell it yet. Who knows? Maybe in 5 years, Apple is going to go to $2,000. He's not under any obligation to sell it after 6 months. You know what I mean?
Yeah.
So, T doesn't have to exercise if he doesn't want to.
Yeah, no, it's an option.
Yeah,
That's
exactly.
what it's called.
That's where the name comes from. It's an option. He doesn't have to.
Mm.
It's just if he wants to. That's why it's called a right, but not the obligation to. Futures
Could
is
it
a
be
bit
for-
different.
Could it be forced to?
Well, not in options.
No, I mean not in options, another type of derivative.
No, not really. Futures maybe.
You have to.
Yeah.
It's not. That's not the case.
It's in futures you do.
Okay.
But I mean, there is some sort of obligation aspect to it. This guy, if this guy calls this guy and he's like, I want your shares now, this guy has to give it to him. Like he's obligated to. There's
Because of the contract.
because of the contract, yeah.
That's what
And
you
because
mean.
this guy already paid $1,000. Like
it's
you're
a
not gonna
no,
tell
yeah.
me no when I already gave you the money, right?
How do they set the contract expiration dates? Because if he just holds the contract indefinitely, the market's just gonna go up, and you can use it at any time that he keeps it profitable.
It's timed, right?
It's time.
It's a time limit.
Yeah. We said
And there's a difference because some are timed that you have to buy them the day of, and some are timed that you can buy them up until the day of.
where is it? Oh, we said derivatives depend on time, price of the stock, and a certain goal. In this case, the goal was 250. You want to buy it at 250. You can set this to be way higher or way lower. We're actually gonna get into that right now. Does anyone want to look at this before I?
I think he's at. Like your question is like, why not just do like 5 years from now because it's guaranteed going to go up in your opinion.
Yeah.
But the thing is, the further in the future, the more expensive it is.
Because
So
there's
doing-
more time for it to go
Yeah.
up.
So like the initial price you pay for that seller of the option to get a guaranteed win will be a lot higher.
A
because-
lot higher. So this guy, instead of paying 1,000 for 6 months, if you do like 5 years, then he'll
It's gonna be like 10.
yeah, it'll be
20.
like like the gain won't even be worth it compared to you just buying and holding the stock.
Let me explain. He's expecting in like the short period of time a big swing in the price of the stock. It's very different than like a slow gradual move upwards. So he's paying a considerable amount of money because he thinks that the stock's gonna double in the next 6 months. Versus like the stock market's average return is like 6 or 7%, it's not gonna double in 6 months. So that's per year. So it's short term versus long term.
Does that make sense?
Yeah.
So
If you think the stock
For-
price is gonna go down, can you do the opposite of this?
we're gonna get into that after we do this. So let's just simulate how the prices would change due to time. So just for everyone's knowledge, options are they have expiries at every Friday. So let's just say today's Friday, right? Now, 1 week from now, which is 7 days, 14 days, 21 days, 28 days, and that's enough for that now. We call these, let's call this 7 days. We call this 7 days till expiration. 7 days until expiration. This is 14 days till expiration. 21 days till expiration. 20 days till expiration. Let's say all of this is at Apple. The sort of, what's this called? I forgot. Like the call put spread.
Spread. Yeah, but and then put for now like do 0 DTE.
Yeah. 0 DTE.
And then you just put like all the numbers of the prices.
Say right now it's 250. Current. 225. It's going to be much tighter than this in real life. It's going to be like 245, 240, 235, 230. But we're just gonna do this for simplicity. 200.
What was like that one website? Is it Trading View?
Trading View, yeah.
Let's see spread on there.
Yeah. Can you show it again? Yeah.
Should have put this over there.
Oh,
So this is what he's drawing. So these are the strike prices are basically the prices that you think Apple will go to, and the one in the middle is the current price. So 257 is the current. And you can basically essentially like bet on it going all the way down to 235 or it going up to 280. The further away the expiration, the more expensive it'll be. So if I'm gonna bet Apple's gonna go to 235 by the end of the week, the odds of that is like 0. So it's gonna be very cheap.
Because there's only 1 day left.
Exactly.
There's only 1 day left for Apple to fall to 235 and you make money.
Yeah, something crazy would have to happen for Apple to just go to 235 in 1 day for 1 week for like no reason. Like that'd be a pretty big difference. So it'd be extremely cheap.
And so buyers see that and sellers see that and they value it at way less. What's it at right now?
For what?
257.
The price for a call at say 225, or just the lowest one you see.
230.
Did 1.34? Is that?
Yeah, yeah.
No,
the-
this call is 224. Is that? Or do you go off this? I don't.
The
do
price,
this.
24.04.
Is that times 100?
24.04. In reality, it's 2,404.
It's just that times like 100.
Yeah.
Not times 100.
Because this
So,
is per share. This is
whatever-
how much you're paying per share.
Like whatever this price is, like times 100, so just move it like 2 decimal places, and that's what you get.
So right now, on Friday, if the current price is 250, why would you buy a call for it to go to 225? There's absolutely no reason. It would have to go down $25. Apple would have to go down $25, which is huge for a company at this size. For you to even make money, or even break even from buying this. Let's say we go on the opposite end. Can you see what it's at like 325, or is it even double? 9 to 1 or 6 to 1, which is 8 hours.
6 to 2.
Oh, right after. Okay. Anyways, something huge would have to happen to Apple for it to go up this amount, $25 in 8 hours.
Typically it goes like plus minus $1, right? Something like that. Typically it goes plus minus $1 or $2 per day.
Yeah, the percent change wouldn't be too much.
Yeah.
On like an average day, you wouldn't go. It would like if it's at
A couple cents.
Yeah.
Yeah.
Hey, why is that one $3?
59.
Is that you sure the 300 one is $3?
No, I think we looked at the wrong one. Okay.
So it's about that.
What was it? 22. Yeah, you're right. It's 22. Can anyone guess why it's more expensive here than now?
Because there's more of a chance for a price change.
Yeah, exactly. There's more time for Apple at its current price to go up to 300 in 28 days than if there was
The
in
rest of
8
it.
hours. Exactly. And same for here. There's more time. I guess we didn't go over
I have a
in the
question.
money, out of the money.
I have a question though. The prices, there isn't a huge amount of difference, even though there's, think about it this way, 28 days is like 20 more times chance of something like ridiculous to happen. But the price difference is only 3 times, or less than 3 times.
Like price
Yeah,
difference
between
here.
0 to 1 day and 28 days.
Yeah.
Yeah, but the price changes like as
It
it gets
does.
closer.
But
You're
you're
assuming-
gambling on like a ridiculously low probability event.
Yeah, but you're assuming that like
Why
price,
is it 28
price
times?
isn't, stochastic. This is
If it has
we call it
events happen,
stochastic
price
motion.
will
Okay.
change.
It goes up and down sideways all the time. And so it's not really a 28 times more chance. It's the true answer is it really just depends.
Okay.
So in 28 days, the prices of the stock can either go up or go down,
Mm-hmm.
and then.
And you're just betting on that, basically. Or not really betting, but
Okay, and depending on the prices on the stock, if it drastically goes down, or if it just goes down, that's when people tend to buy. And
Yeah.
then if it just goes up, that's when everything stays kind of stagnant. Or
Yeah.
It's kind of about right.
That's like supply and demand and stuff.
yeah.
Yeah.
Price always breaks out eventually. Like indices go up.
Mm-hmm. That basically what it's trying to say is that like
You don't
stocks
know.
always go up, basically.
Yeah, over over
over
time,
time.
everyone expects it to go up, but there's no like guarantees.
It's based on sort of the economy.
Like if you just look at like a long term like scale, like it always just ends up going up.
Mhm.
Like if you just,
That's why if you look
like,
at
just pull up like the S&P 500 and go like on
Well, in most
Yeah.
countries it goes up, some
yeah,
things
search.
happen.
yeah.
Just search up stock.
Yeah.
So this is
And then go out like
go to like months.
There's like one list.
it's your way like
Just go on Google, look up S&P 500, switch it to max. So yeah, just use it.
Yeah, do it like every month. Yeah. Here you can click A. Click A at the bottom.
Okay. Quick.
Wait, where'd it go?
Wait, it's because you started it. But the S&P 500 is like. So you see like how like all the way like in 2017, or like over here like 2015, so like how much like
And
100,
in reality,
190?
the S&P 500 has been
And
around
that's,
for
like,
years,
all of it.
way before that, 1950, 40.
Is it increasing because of inflation or because of growth of the U.S. economy or what?
Growth.
Growth of the U.S. economy.
Growth. This is tracking the 500 most popular or biggest companies in the United States. That's why it's called S&P 500. I can't remember what S&P stands for. But as companies go up, this ETF, we call it exchange traded fund,
Yeah.
something like that. It goes up also as all of these companies go up. And all of these companies go up because first off, they're the biggest companies in the United States that have the biggest, support. And the economy itself is growing.
So, example, like, let's say like Tom Ford, right? He, or the company like drops a cologne, right?
General Motors is actually on here.
Okay. Oh, alright, General Motors, like Ford, right?
Mhm.
If they just produce a really like banger car, past, like, oh, they're making a car, right? And it's not electric, you know, people, like, it's like, you know,
Yeah, like you mean like an actually good car, yeah.
yeah, an actually really good car. And, I guess you buy stock from Ford, right now, and, cause you research, like, alright, they're gonna make a car in the next 3 years, 4 years. Once that 4 year hits, they produce the cars. Capitalism, that company, like, they're making money because these cars are selling like hotcakes. Now you're making money because they're making money. And then.
Because you're
and you
a
bought it-
percentage
The
holder.
company's more valuable.
Yeah, the company's more valuable because you bought it when, you know, everything was stagnant in a way, or not low, but stagnant.
And then it popped. Yeah.
That's
Or you can buy it, if you're like a wizard or something, you can time it exactly
Exactly.
when it goes down.
When was that?
Just like over here. God, I
During the
did a
tariff
huge trade.
stuff.
I actually.
Are you sure?
Like,
Anyways,
people like, it's like COVID.
That's
times.
COVID inflationary period.
It's like people might have like some people might have like I'm assuming like some
That's the
people like
COVID
shorted
drop.
COVID right before, and they just made like a ton of money like when COVID like dropped everything down.
That's true. But think, actually,
This is the most recent sort of crash.
Yusuf,
Went
the one
down.
in the middle, the big slump, that's because of high inflation during the Biden.
This one, yeah.
That's high inflationary period.
Yeah, and it just goes to show you this does really move also on economy.
Yeah,
Uh,
it's a big drop.
It's
The
also
thing is,
why
hard
the
to predict.
2008 crash was also huge.
Here's the thing, I'll just say, how many people in January 2020 could have predicted that literally in 2 months the entire like world would be shut down because of COVID?
Absolutely no.
Yeah, that's the thing. It's
Yeah.
very hard to predict.
Yeah. No.
There's people who do it for a living and they have no idea. So
Can you create inflation to
Yes.
make money?
banks can create inflation.
I mean,
Inflation is
I mean,
money.
Trump,
yeah.
our favorite president, right?
Inflation is the amount of money in the economy. So if the bank just prints a bunch of money, you'll have high inflation. And there's countries that the US did this in 2021 because the economy slumped from COVID, and by printing money, you stimulate businesses to go and build stuff.
This
That's
is
how they,
this is
that's
what
how
he's
they
talking
recovered
about.
from COVID recession.
Biden increased inflation
Yep.
artificially, which caused the prices to go up. And then when people realized it's BS, it all went down.
Well, not BS. The economy stopped growing because
How
it
do
was
you-
too
how do
high
you
inflation.
create-
It was 9%, so companies
you
couldn't take
print
loans
money.
anymore. They just stopped building stuff.
I guess that's also another point. Yeah.
It's
What?
like the banks have like so much money that they could just like manipulate like the market anyways.
Let me explain it this way.
Not necessarily
Not
the
like
banks.
necessarily, but like they can move, like they have power to like move price.
But there's
explain.
also regulations,
Yeah,
you know, on
yeah,
that.
for sure.
Let me explain.
Yeah.
Banks loan money and the government loans money. The government can jack up the amount of money it wants to loan to remove money from the market, from the economy, which is going to slow inflation because the government's always printing money. But if everyone buys government securities, government bonds, that money is removed from the market because the government has a big vault. So that slows inflation basically.
So, what's up?
I keep going, I was like, talking.
Here,
Yeah.
we'll keep going. Technically, it ends at 3:30. You guys are free to leave, but
Keep going.
we'll just keep going. So I want to answer your question though. What if Ford created a massive, pop of a car? So there are sectors, we call them sectors, in the S&P 500. I can't remember which one. Is it consumer sector? The cars? There's a consumer sector, and I think Ford is part of it. The consumer sector includes, all the consumer companies, the top consumer companies in the S&P 500. And so, if Ford is one of them, and Ford makes a very good car, buyers are going to be like, oh my god, Ford is actually doing pretty good stuff right now. I think people will actually value it higher in the future. So they go and they buy and buy and buy. The sellers are overwhelmed. There's more buyers than sellers. And so price moves this way. When price moves this way, the consumer sector moves up too, because a portion of it is part of Ford. Or Ford is a part of the consumer sector, right? And since the consumer sector is part of this ETF, the S&P 500, the S&P 500 also moves up. It's kind of confusing. It's like cause of a cause of a cause.
I have
But
a question though.
if Ford made like a really good car, wouldn't the stocks of the competitors go down because they're going to make less money because they're getting outcompeted?
Not by too much though. Like it won't be.
Or wouldn't the sellers raise their stock prices, so it's harder for the competitors to even buy them out?
Also-
yeah, but that just moves the stock price upwards, which is what's going on anyways.
Yeah. No, if you look at, you know, two of the biggest, I guess, I won't call them biggest, but if you look at Tesla and Lucid, for example. Do you all know Lucid?
Yeah.
The car
Lucid?
company? Lucid,
Oh, LUC, I mean.
yeah. They're two competitors. Tesla is making electric cars, Lucid is making electric cars. When Tesla goes up, Lucid doesn't necessarily go down. It sort of moves sideways. More people are more interested in buying Tesla than they are selling Lucid, just because Tesla made a good announcement.
Tesla's.
Obviously, it does go down still, but it's not catastrophic.
Lucid is basically bankrupt.
It is. It's bad. It's bad though.
So wouldn't that be a good time to buy a stock there?
Well,
If it's bankrupt.
Or banger?
Well, if it's bankrupt, the company could go out of business and your stock would do nothing. It could keep going downwards. So that's the thing. People think that when the stock is down, like this is the whole thing with GameStop.